The Lifetime Learning Credit is an education credit worth up to $2,000. In this video, I will break down some things you need to know about this credit, from qualified expenses to income limitations, and even a strategy you might be able to use to maximize your tax savings. I'm not giving you tax or legal advice. I'm just sharing information on how the Lifetime Learning Credit might help you save thousands on your federal income taxes. Each taxpayer's situation is different, so please check with your financial, tax, or legal advisor to help you with your specific situation. The credit amount is 20% of your first $10,000 of qualified tuition and related expenses. So what expenses qualify for this credit? The allowed expenses are tuition, fees paid to the school, such as equipment fees and activity fees that all students are required to pay, and course materials, such as books required for enrollment. Unlike the American Opportunity Tax Credit, you can only include expenses paid for books and materials that were purchased directly from the school. There are some expenses that are not qualified expenses, even if they are required for enrollment. These expenses are insurance, medical expenses, including student health fees, room and board, transportation, and personal, living, or family expenses. It's important to note that the Lifetime Learning Credit is non-refundable. This means that it can reduce your tax liability dollar for dollar, but it will never reduce your taxes below zero, so you will never receive a refund for the credit itself. There's no limit on the number of years you can claim the credit, but there are income limitations. For 2024, if you're married filing jointly, you cannot claim the Lifetime Learning Credit if your modified adjusted gross income is more than $180,000. For all other taxpayers, the limit is $90,000. If you're married filing jointly, the credit begins to phase out between $160,000 and $180,000. For all other taxpayers, it begins to phase out between $80,000 and $90,000. To claim the Lifetime Learning Credit, you must meet all three of the following criteria. You, your dependent, or someone else paid qualified education expenses for higher education. You, or your spouse or a dependent you listed on your tax return is the student. And the student is enrolled at a qualified institution. With that in mind, you can only use qualified education expenses for the following students. Again, the student must be enrolled at a qualified educational institution. A qualified school will typically send you a 1098-T form. The student must be taking courses toward a degree or a recognized educational credential, or to improve job skills. Therefore, it's not required that the student pursue a degree if they are trying to enhance their job skills. The student must be enrolled for at least one academic period that began in the tax year. This can even be a short academic period, such as a winter session. Academic periods are determined by the school. The number of hours they are enrolled doesn't matter, but they must be enrolled at least one course. So let's talk about the 1098-T form, the one you're supposed to receive from your school. In most cases, you should receive one, but sometimes you won't. For example, if your qualified education expenses were completely covered by scholarships, you might not get a 1098-T. But here's the thing, even if you don't get the form, you might still be able to claim the credit. You just have to prove that you have a dependent student enrolled in a qualified institution and show how much you actually paid in tuition and other qualified expenses. Now, when you do get a 1098-T, you'll see a number in box 1, but here's where it gets tricky. That number isn't necessarily the amount you can claim on your tax return. You need to double check to make sure that you're including amounts paid for qualified tuition expenses during the year. Unfortunately, not everyone qualifies for an education credit. You cannot claim the Lifetime Learning Credit if someone else claims you as a dependent on their tax return. You're married, filing separately, and either you or your spouse is the student. You or your spouse were a resident alien for part of the year and didn't elect to be treated as a resident alien for tax purposes, or you already used the same education expenses for another education benefit. For example, you can't claim the Lifetime Learning Credit for the same expenses you used for the American Opportunity Tax Credit. Here's something most people don't think about. You might be able to get a bigger tax credit by paying some tax on your scholarships and grants. Sounds weird, I know, but let me explain. If your student receives grants or scholarships, it could reduce or eliminate your ability to claim the Lifetime Learning Credit, unless you choose to count all or part of their scholarships or grants as taxable income. Normally, scholarships, grants, and VA assistance are tax-free, but because you can't claim tax credits for expenses paid with tax-free assistance, you might want to reclassify all or some of that aid. Here's how that works. Instead of saying your scholarship or grant paid for tuition, which is a qualified expense, you could say it covered non-qualified expenses like room and board. That means you pay for tuition out of pocket, so now you can claim the lifetime learning credit. It doesn't really matter how the school classifies the grant or scholarship. The student can choose to count the funds toward non-qualified expenses as long as it doesn't exceed the actual amount of those expenses. Of course, there's a trade-off. If you do this, part of your scholarship or grant becomes taxable income. But if your lifetime learning credit is worth more than the extra tax you'll pay, it could still be a win. This only works if the terms of your grant or scholarship or other tax-free assistance allows the money to be used for living expenses, or the funds can be used for tuition and related expenses. If the grant or scholarship specifically says for tuition and related expenses only, then this strategy won't apply. If you decide to make part of the student's tax-free assistance taxable, that income has to be reported on the student's individual federal tax return, even if you claim them as a dependent. But now you won't reduce qualified education expenses by the amount that was included in income. One thing to be careful about, though, is how this might affect the student's financial aid in the following year. For instance, if you increase the student's taxable income too much, they may no longer qualify for a grant. So when deciding how much of your education assistance to count as taxable income, think about how much you'll save in total federal and state tax benefits, both for you and the student, and whether the extra income could affect your grants and aid the following year. Honestly, this is a balancing act. It may take some number crunching to figure out what actually benefits you the most, but if it means getting a bigger tax break, it might be worth the effort. Education tax credits can be confusing, but once you understand how they work, you can maximize your benefits. So please take the time to review your options and don't be afraid to run the numbers. It could save you a lot of money. I've mentioned the American Opportunity Tax Credit a few times in this video. I made a separate video all about it as well. Please watch the video in the upper left of your screen if you want to learn more about that credit. See ya.